we're going to cover 4 different topics, and those include the qualified disaster loss deduction, administrative tax relief, taxation or how to delay taxation when there's a gain to report, and then retirement account distributions. So in order to be eligible for these benefits, you have to reside in or operate a business with its principal location in the federal disaster area. And the IRS relies on FEMA to provide this information to them. So then turning to the qualified disaster loss deduction. I'm going to talk about this in a compare and contrast way with the casualty loss deduction. It really highlights what a big deal this is for our community and kind of why all of the tax professionals are geeking out on it. So the casualty loss deduction is always available for eligible taxpayers. It's in the Internal Revenue Code 165, but the qualified disaster loss deduction is not always available. It's not part of the Internal Revenue Code. But nonetheless, they both provide a deduction for loss to personal use property that's unreimbursed. So what that means is personal use property. We're talking about cars, your personal car, your home, the contents of your home, recreational items, like golf carts, boats, things like that. That is not reimbursed by insurance or some kind of other disaster-related funding that was given to you to repair or replace the property. And like I said, the qualified disaster loss deduction is not always available. It takes congressional or presidential action in order to become available. And so in December 12th of 2024, President Biden signed into legislation the Federal Disaster Tax Relief Act of 2023. And that made the qualified disaster loss deduction available for any federally declared disaster between January 2020 and January 2025. And again, personal use property. So when you're calculating the loss, you look at the damage to each individual item. So if there was damage to my car, then I would calculate the deduction for my car. And then if I had damage to my home, I would calculate the damage to my home. And you add those together. So each loss is calculated separately, subject to a caveat for the home. The home includes, when you're talking about loss in the home, it includes the structure, the land where it sits. So that's like, your landscaping, and then any other improvement, any other structure located on that property. So it's everything that would be given to you in an appraisal. And that's considered a single item. So when you're talking about damage to the home, say your shed was destroyed, you're not looking at the loss just in the shed, you're looking at the loss, the decrease in fair market value to your home now that it doesn't have that shed. So that's really important just to think about that as a whole. So the differences in the casualty loss deduction and the qualified disaster loss deduction. So they both are, the loss is both calculated by the decrease in the property's fair market value. So what was the property worth before, and what was the property worth after the disaster? They differ in that the minimum amount required for the deductions. So for the casualty loss deduction, it is reduced by 10% of AGI and then less $100, whereas the qualified disaster loss deduction is only reduced by $500. So let me give you an example to put that into context. If the taxpayer has AGI or adjusted gross income at $100,000 and they have $20,000 in loss, with the casualty loss deduction, their loss is going to be $9,900, and that's 10. So the $20,000 less 10% of AGI, which is 100,000 times 10% is 10,000. So 20,000 minus 10,000 minus $100. However, for the qualified disaster loss deduction, the loss is 19,500. So you're getting a lot more with the qualified disaster loss deduction. And secondly, the casualty loss deduction is a below the line deduction, which requires the taxpayer to itemize. Whereas the qualified disaster loss deduction is above the line, and so it functions to increase your standard deduction. And we're gonna come back to that and look at explain that a little bit more in detail. But as I said, the qualified disaster loss deduction requires additional action. It requires either congressional or presidential action. But then the fourth difference, which is pretty significant, the qualified disaster loss deduction provides for safe harbors for determining the amount of loss. And that just means that there's an alternate way to calculate the loss. Whereas for the casualty loss deduction, the only formula is the decrease in fair market value. And so that's looking at what the property was worth before the disaster and then after the disaster. And then, so why is this distinction between itemized and standard deduction important? So since 2018, there were the Internal Revenue Code was revised to increase the standard deduction. And from now, most taxpayers don't benefit from itemizing. In fact, in 2022, it's estimated that less than 10% of taxpayers itemized. So more than likely, most taxpayers are going to be taking the standard deduction. For 2025, the standard deduction for a single person is $15,750, and for married taxpayers, $31,500. The slide uses the 2024 figures. Itemized deductions include things like mortgage interest, medical expenses in excess of 7.5% of AGI, property tax, state tax, and charitable deductions. Like I said, medical expenses must exceed 7.5% of AGI. So you don't get the 100% benefit of your out-of-pocket medical expenses. So if a taxpayer's AGI adjusted gross income is $100,000, then if they itemize, they can only claim medical expenses in excess of $7,500. So you have to have a lot of mortgage interest, or a lot of medical expenses in 1 year, or live in one of the East Coast states where property tax are really high, really to benefit from itemizing right now. So if your itemized deductions don't match what your standard deduction is, you're not going to benefit from the casualty loss deduction because you still have a bigger deduction with the standard deduction. And especially homeowner or people who don't own their home, they're not going to have property taxes and they're not going to have mortgage interest. So they wouldn't really benefit from the casualty loss deduction. So in this example on this slide, you can see that Linda and Eric are going to benefit from itemizing because their itemized deductions are a little bit over $34,000. They also have almost $10,000 in charitable donations, which isn't likely for most taxpayers. So they could benefit from the casualty loss deduction because their itemized deductions get to their standard deduction. But Sean, on the other hand, he only has $4,800 in itemized deductions. So even if his casualty loss deduction was $10,000, that would only get him to $14,800, only $200 more than his standard deduction. And so, however, if his with the qualified disaster loss deduction being available, that $14,000 plus $10,000 in loss, that brings that up to $24,600. You can kind of see how it's a huge benefit to be able to increase your standard deduction right now. So, kind of diving into actually calculating the loss. So it's going to be, you're going to look at your adjusted basis in the damaged property. An adjusted basis is generally the cost to purchase. And you'll also add whatever you've invested in the property. But for these purposes, we can just think of whatever you paid for it to purchase it. And then you look at the decrease in the damaged property's fair market value. Whichever between those two is the smallest, then your loss is going to equal that smaller amount less insurance or any other reimbursement you received. So for example, I purchased my home for $140,000. Prior to the disaster, it was worth $200,000. After the disaster, it's worth $50,000. I received insurance proceeds of 100,000. So the decrease in fair market value of the home is that 200,000 minus 50,000, which is $150,000. Because I purchased it for $140,000, my cost basis is less. So I'm going to use that $140,000 minus, and then I have to reduce it by the amount of insurance proceeds I received, which is $100,000. So that's $140,000 minus $100,000 equals $40,000. So that's my loss for in that example. Now, switching that, if say your adjusted basis is increased to $180,000 prior to the disaster, worth $200,000, after the disaster, worth $50,000. Now your decrease in value is your decrease in value is going to be $150,000, which is smaller than what you paid for it at $180,000. So you would subtract $100,000 from the 150 decrease in fair market value to get a loss at $50,000.
There are a couple questions for you in the chat, Gabrielle.
Oh,
one is, does that include FEMA reimbursement from Mitzi?
So it does include FEMA reimbursements if it's specifically earmarked to repair or replace the property. So if you if you receive FEMA money like designated to rehabilitate your property, yes, then it does count. But if it's general, like the special needs assistance, the 750, that would not reduce it because that was just general funds like immediately. So it has to be specifically designated to repair or replace the damaged property.
So Gabrielle, just to clarify, if my house was worth 150,000 before the storm and now it's worth 100,000, but I got 25,000 from FEMA, can you?
Mm-hmm. Yeah, assuming that $25,000 was specifically for your property to repair it, then sorry, what was it worth before, Helene?
150.
150. So and it's worth 100 afterwards. So that's 150 minus 100 is 50,000, and then you subtract that 25,000 that you received from FEMA, and your loss is going to be 25,000. Why is calculating the decrease in fair market value problematic? I mean, could you imagine having to it requires an appraisal before and after. So after Helene, can you imagine getting one of the five Asheville appraisers over to your house to tell you what your house is worth now, that there's a hole in the roof and 3 broken windows? It's not feasible. And, most people don't have appraisals for the contents of their home. And so recognizing this, I think the IRS created these safe harbor rules. So here they are. So we've got cost of making repairs, and that's limited to $20,000. But as long as the repairs were performed by a licensed contractor who gave you an itemized written repair cost report, then you can use whatever the repair costs were up to $20,000 in order to value the decrease in fair market value. The second one is de minimis method. And this has to be less than $5,000. And it's a good faith estimate of whatever the property was worth before and whatever the property is worth after. So this is really appropriate for personal property, like contents of the home. Say your basement was flooded and it ruined a lot of things in your basement. It's not really feasible to, like I said, to have appraisals for those kinds of things. And so you could rely on the de minimis method to calculate the value or the loss for that flooded basement. And then the third is the replacement cost method. So so you use the replacement cost, whatever it costs to replace the item that was damaged. And then you decrease by 10% for each year you owned it. So say your front door was destroyed and you had to buy a new front door. Whatever the front door cost, less 10% for each year you owned the previous front door. So say you bought it 5 years earlier, so you would decrease by 10% 5 times. And then the insurance method, That's an estimated loss report prepared by your homeowner's insurance. And you can use that valuation as the decrease in fair market value. These two are specifically allowed, the de minimis and the replacement cost method are specifically allowed for personal, like personal belongings, like household items, things like that.
There's a quick question. Are you allowed
Mhm.
to switch between methods per loss?
Yes, you don't have to use the same method for each item that was damaged. You can use different methods for different pieces of property. So if you're using the safe harbor rules, these are the instructions that the IRS provides. So you report the loss on Form 4684. It's just an extra attachment to your tax return to the 1040. You want to attach a statement to that Form 4684 that says that you're relying on a safe harbor method from Rev Proc 2018-08. If as long as you qualify to use these safe harbor methods, which we do, the IRS won't challenge your determination, and that's that's a big deal. Very rarely does the IRS ever say that it won't challenge something, and so attaching that how you get this protection is you attach that statement to your 1040 essentially, and it just needs to say that you're which method you're relying on. Extraordinary action from the IRS. Made this they've put out these couple statements about how kind of how they would audit or examine this qualified disaster loss deduction. And it's very rare for the IRS to say anything like this, honestly. You know, essentially, they understand that, many people experience like extensive damage with disasters. And as long as the taxpayer is acting in good faith and trying to be reasonable, then the IRS isn't going to challenge the taxpayer's determination. They also recognize that records might not be available, and they're willing to consider whatever you can come up with, which again is really out of the ordinary for the IRS. So I think I mentioned before, so when you're calculating the loss, you have to deduct whatever you received in reimbursements, whether that's insurance proceeds or other disaster funds that were specifically earmarked for to repair or replace the property. Also, if something was done for free, I know there was a lot of like debris removal. You wouldn't be able to calculate that into to your loss because it was performed for free. However, unrestricted gifts of cash, those if you could do whatever you wanted to, if it was just help you get a hotel or just to kind of help with the initial cost of not having anything, just like personal items and things like that, then you don't have to you don't deduct those like unrestricted gifts of cash. You don't deduct that from your qualified disaster loss deduction. This is a link to an IRS publication, and it's a workbook. Essentially, it just lists like all kinds, like room by room, like the different types of furniture and things that you would have in there. I mean, it's got like lamps, dresser, TV, things like that. And I don't know how helpful it is, except to help you recreate what might have been damaged in a room. But it is. They do make that available, and there's the link to it.
There are a couple questions, Gabrielle.
Okay.
Let's see. Can de minimis method be used for home repairs if they don't total more than 5,000?
Hmm. Yes.
And then if the loss was erosion of your property or land into the river and you got an estimate for 50,000 to add stone and plants to prevent further loss, is this a legitimate loss to include?
So your estimate is to repair the property and to make sure that it doesn't happen again.
Yes. And loss of the actual land, like 5 feet along a 200-foot stretch of the river.
Yeah, so like the loss of land, because before the hurricane, you had more acreage than you do after, and that's going to decrease the fair market value. So that part of it is can be calculated in a deduction. The improvements beyond what was there cannot, because because it wasn't existing before. It wasn't existing in that form before the hurricane. Does that make sense?
Yeah, I mean, difficult to calculate where that would go, but
Yeah, that's what I was just about to say. Like, I don't
yeah.
know how you apportion those. It would probably to be on the safe side, I would get a licensed contractor to kind of divvy it out. So the timing of the deduction. So you're going to report your loss in the year when you feel it's reasonably certain you're not going to be reimbursed for that loss. So say you had a homeowner's claim and the homeowner's insurance didn't make a determination until January of 2025, February of 2025, then you would report your loss in 2025. Otherwise, most of the time, it's going to be the year that the disaster happened, which for us would be 2024. And if you've already filed your 2024 tax return and didn't include your deduction, then you just need to amend your return. And you have 3 years from the due date of the return to amend. So that would be 2028 is when April 15th of 2028 to amend your 2024 return.
Yeah, there's one more question, Gabrielle. Can the qualified disaster loss deduction be used for losses related to a small business?
Yes, it can. Um, but it's a little bit different calculation because for business purposes, it's always available. The casualty loss deduction is always available. And so uh it not as an itemization. It's so because it's always available, the calculation is a little bit different and this isn't entirely on point for businesses. But yes, it is. You can certainly use it for businesses. I should also note um, if you use your home for like if you have a home office and you have and use that as a deduction on your tax return, then the qualified disaster loss only applies to this percentage of or like the topic like we're talking about today only applies to the percentage of your home that is for personal use. And like I said, when it's business property, it's going to be on the Schedule C, and it's just different. It's a different calculation. Moving to rules for retirement accounts. There are a couple types of relief that they provided for distributions on retirement accounts. You could have taken a distribution up to $22,000 between September 25th, 2024 and March 27th, 2025. If you took a distribution during that time period, then the 10% early the 10% penalty is waived, and you can spread the tax on that distribution over 3 years, which means if you were able to repay it in year three, then you wouldn't have to pay tax on any of the distribution. And the way that you would fix the parts that you've already reported as income, you just have to amend your previous returns. So so you would have already had to take the deduction or take the distribution. But if you did take a distribution during that time period, just know that you can spread it out over 3 years and you have 3 years to repay it to avoid paying tax on it. And then looking at administrative tax relief. So the primary form of administrative tax relief is going to be an extension to file your return and extension to pay tax. We were afforded, it came in a couple different declarations, but essentially we were afforded until September 25th of 2025 to file and pay our 2024 taxes. And that was federally in the North Carolina Department of Revenue. They followed the IRS in that. There are some other kinds of administrative tax relief that, because the window has already closed, I didn't discuss them, but hopefully we'll never be in this position again. But in the event you are, there are some other things. But I've been seeing a lot of more than I would like to admit, a lot of clients coming in and either the IRS or DOR got this wrong. They're being assessed late penalty, like a late filing penalty or a late payment penalty, even though they did it before September 25th of 2025. I've been really successful in having those issues corrected just by calling. The IRS has a top secret disaster hotline. It's really hard to find the number. But if you're and they're actually pretty accessible. Um, the number's listed there on this slide, but calling the hotline, um, they've been able to resolve a lot of those issues um, that were caused because the IRS wasn't recognizing the extension to file and pay. Same with DOR. Been able to resolve those issues with phone calls. Okay, so taxation of disaster-related fines. So there are a couple of types of disaster-related fines that aren't taxable. So a qualified disaster relief payment, which is a payment for reasonable and necessary personal or living expenses or funeral expenses, rehabilitation or repair of personal property. That property, but it has to be property that wasn't insured. And then same replacement or repair of personal property or personal residence. And again, that's for damage that wasn't covered by insurance. Qualified disaster mitigation payments also aren't taxed. And that's to, so like in that previous example, if you receive funding from a nonprofit to build the retaining wall so that wouldn't happen again, then that wouldn't be, that payment for the retaining wall wouldn't be taxed. So insurance payments for contents of the home, just like a bulk payment for everything in your home, that's not taxed. Payments for personal property only becomes taxable if it's for scheduled personal property, which means things that are actually listed out on your insurance policy, which a lot of times will be jewelry, art, collector's items like coins and things like that. But otherwise, if it's just for contents of the home and it's a bulk payment, then it's not taxable. So insurance proceeds can be taxable, and when they are is, so if your insurance proceeds, if that's more than your cost basis, so if you paid $100,000 for your house, but you received $150,000 in insurance money, then that $50,000 is considered a gain and is technically taxable. But the IRS has provided rules that allows you to delay reporting that gain. So if you, and this is for personal property or real property like your home. If you buy replacement property, which functions in the same manner as the property that was destroyed, within the replacement period, which is generally 2 years, but can be extended to 4 years for your home, you can delay reporting any gain till you sell that replacement property. And so here's another simple example. Your home costs $75,000. Your home was destroyed by a tornado. It was worth $150,000. You received $146,000 from the insurance company. You had a gain of $71,000 because it's 146 minus 75. In that same example, if you rebuilt your home and it cost you $144,000 to rebuild your home, then you would have to report gain on $2,000 because you received $146,000, but you only spent $144,000 on the replacement property. So you're gonna have a gain of $2,000. So generally, the year you receive the money from the insurance company, that's when it would be taxable. But you can delay reporting that gain by purchasing a replacement property during the replacement period. And what it means by delay in reporting that gain, your cost basis is just going to travel to that replacement property. And so then when you sell it years down the road, the difference would be whatever you sold it for and that cost base that carried over to the replacement property. In the replacement period, and as I said, the replacement period can be extended to 4 years for your primary residence.
So Gabrielle, there are a couple of questions. Misty asks, is this only for insurance reimbursement, I'm guessing, versus other resources for home rebuilding and repair?
So that really gets into into who's paying it. So if it's a nonprofit, or FEMA or government agency, something like that, then it's going to fall into this qualified disaster relief payments that aren't taxable. I don't really know. I'm trying to think of some other programs that function kind of like insurance. I think sometimes there are employer sponsored plans that can function a little bit like insurance, but nothing's really coming to mind. I mean, generally it's just your homeowner's insurance.
And then there's one other question, Gabrielle. If folks were not aware that they could deduct disaster loss in their 2024 tax returns, can they go back and reevaluate or I don't know, amend, I guess
You
would be the
amend,
word.
yeah. So you just amend your 2024 tax return. And like I said, you have until April 15th of 2028 to do that.